Our next speaker is Will Atkins. He's our Vice President for Education, and he'll be speaking to us about the Heritage Foundation's plan for tax reform. Help me welcome Will Atkins.
Thank you, Roger. I am actually really excited about this. Those of you that have been in the club for a little while and heard my icebreaker, I love politics. At some point when I get out of the military, I'm probably going to enter politics. So getting the chance to speak about saving the American dream is right up my alley. So Roger, thank you very much. I appreciate you bringing forth this project for us. Now, Will just got done talking about just government spending in general and how the Heritage Foundation's plan is reduce spending, lower taxes, simplify our tax system, and then move on from there. So I will be talking to you about the tax reform portion of that plan. Now, Benjamin Franklin once said that there are only two certainties in life. It's death and taxes. And that's definitely going to be true for all of our lifetimes. And I would add two other certainties to taxes themselves. And that is that they're complicated and they confuse me. Because now Roger did say generally we're all paying about 25%, but in all actuality it's all over the place, depending on what your family situation is, how many dependents you have, how much money you make, whether or not you're receiving inheritances and where your income is coming from. We're paying anywhere from 15 to 50%. It's all over the place. So Heritage's plan is to simplify the tax system. And this is one aspect of their plan that I greatly admire. I like the simplification part. And there are parts that I actually don't agree with, and I'll talk to you about that a little bit later. I threw out on the table, pretty much in front of everyone, you have a sheet with some slides on it that I'll be speaking to. Because the tax system is so complicated, I wanted to make sure that everyone had something to look at. I'm a visual learner, so I wanted to make sure you could both hear and see the Heritage Foundation's plan. Now their plan takes today's federal tax system and simplifies it, as I said. But first you have to understand what today's system is like. So in order to do that, take this, and Will, since you just got done talking about government spending, you made $100,000 this year, as exemplified by $1. I want you to hold on to that, because I'm going to be asking for some of that back here in a minute. Now today's federal tax system is broken up into basically two parts. Everyone pays a payroll tax, which is about 15%. And that includes your Medicare, Medicaid, Social Security, things like that you have to pay in your payroll taxes. Then you're going to be adding on, depending on which bracket you're in, another 10, 15, 25, or 28% on top of that 15%. So right off the bat, everybody's paying between 25 and 43% in taxes, one way or the other, between both your income and your payroll taxes. Now, 25 to 43% may not seem all that high. I have some personal friends of mine that live in Sweden, which is generally a socialist type government, where they pay upwards of 60% in taxes, but anything that they need for sustenance and living is completely taken care of by the government. You think we have a lot of programs, they get toothbrushes in the mail every 2 weeks because the government says you should change your toothbrush. So here's a toothbrush. Anything that they need for living is provided for by the government, and they pay upwards of 60 to 70% in taxes. Now, in addition to that 25 to 43% that all of us are paying, there are several additional taxes that we see in our day-to-day lives. There's taxes on our savings. When we file our taxes in the next couple of months, you're going to be asked how much income you got from interest in your savings account. So you have interest income tax. You have property tax. If you own a home, you have property taxes here in Little Rock. There's inheritance taxes. If you would like to leave something for your children or for a spouse or for anybody else, there's inheritance taxes on the amount that you're leaving that person. We have taxes on the things that we purchase. Sales tax, 6% here in Little Rock. There's additional taxes on certain types of goods. They're called excise taxes. There's additional taxes on tobacco, gasoline, other items like that. And then you still have your state income tax, which is added on to the 25 to 43% that you're paying normally for your federal taxes. There's a ton of taxes. So Will, what I'd like you to do is take your $100,000 that you worked so hard for, and I'd like you to give me back 30 cents. 30% of it, between 25 and 43, depending on what bracket you're in, that's mine for federal taxes.
Can I mess up my account?
No, I just need 30. Thank you. Now, and if you didn't give it to me, I'd have to audit you. And then, on top of that, you're going to have to give me 7 more cents for your state income tax of 7%, because you made $100,000 this year. Just give me, that'll work. 7 more cents. Thank you. And on top of that, you're going to have to give me 6 more cents, because anything that you want to buy, you're going to have that 6% sales tax, so you better give me 6 cents. And, you're actually not in good health, so you're actually going to die. But you want to live, you want to give that money to your child. You're actually going to have to give me 12 more cents, because that's what it would be for your child. So I just took away 30% for federal taxes, 7 for state, 19 for death tax, 6% for sales tax. You're down to $48,000. You paid 53% taxes. Your buying power is shot. So let's talk about the Heritage Foundation's plan to make that a little bit more simple, so that I'm not talking about 10 different types of taxes, and how we're going to make this simpler. So the Heritage Foundation says, I want one flat tax rate. That flat tax rate is roughly 28% per individual. It replaces your federal income tax. It replaces the death tax, the payroll tax. It replaces all the excises on tobacco, gasoline, things like that. They're also going to allow you to have a Roth-style savings account, which means up to $100,000, you don't pay any taxes on the income that you make in your savings account. Unlike today, where we all are going to pay income taxes on our savings that we've tried so hard to save over the last year. So what they say, basically, is that it's as simple as 1, 2, 3. One rate, which is 28%. There's 2 credits, a $3,500 health insurance credit and an anti-poverty tax credit, which is basically the exact same thing as the earned income credit right now. So, a health insurance and 1 for poor people. 2 credits, that's all there's left. And 3 deductions. You'll have 3 deductions, 1 for education, 1 for charitable donations, and 1 for your home mortgage interest. Simple as 1, 2, 3. That's for non-seniors. If you are a senior, you don't need the health insurance credit because you have Medicare. I was going to say Medicaid, but just Medicare for seniors, right? So you don't need that credit. So they take that credit away and they give you an extra deduction, which is that you can exclude your first $10,000 of income from any tax at all. So for the first, instead of paying 28% on that $10,000, which would be $2,800, you don't have to pay anything for the first $10,000. What that does is it encourages seniors to keep working, at least through $10,000 worth of income, because they don't have to pay taxes on it. So it's simple as 1, 2, 3, whether you're a senior or a non-senior. Now, there's one part about this plan that I actually don't like, and that's the flat rate part of 28%. There is nowhere in this plan that I've been able to find where it's what they call a progressive tax. If I want to use the same numbers on your sheet. If I make $30,000 and I had to pay 30% of my taxes, 30% of that in tax, that means I'm giving up $10,000 and I only made $30,000. Taking away that $10,000 from me is going to hurt a lot. If I made $100,000 and I paid that same 30%, so you would take away $30,000, I would still have $70,000 left over to provide for living and food and things like that. The 30% hurts poor people more than it hurts rich people. Rich people have more money to provide for the basic sustenance than poorer people do. That's why this plan with the flat rate tax that is not progressive, I actually don't agree very much with. One of the ways that they could solve this is much like what they're doing for seniors in excluding a certain amount. If they exclude the first $10,000 or $25,000 of income, then it becomes a progressive tax. If I only made $30,000 and they excluded 25%, or $25,000, then they're only going to tax the $5,000 that's left. So I'm going to pay about $1,000 in taxes, and I made $30,000. That doesn't hurt so bad. And for the people who made $100,000, they have $75,000 left. They're still going to tax 30% of it. They're going to pay about $25,000. So their actual tax rate would be about 25%, whereas mine would only be 4% by paying $1,000 in taxes on $30,000 a day. So there's aspects of this plan that I like very much, and there's others that I don't. But in general, it does simplify the tax system very much. It is simple as 1, 2, 3. And it provides some amount of income for the federal government to pay for Social Security, Medicare, and Medicaid, which we'll have speakers come up and speak to later on. Thank you for your time. I'll be around for questions after all the speeches are done.